Welcome. This is the Trading Pit, your home for sophisticated takes on the crypto markets. It's May 2nd, a brand new month, and I'm excited because here in the studio is JJ and Ben Lilly of JLabs. I am your host, Marconi White. In today's show, we're unpacking the market's price action, dissecting the Fed's latest remarks, and refreshing our view on how the debt apocalypse might play out. Scary, scary. But first, it's rapid fire, where I look for simple answers to complex questions. Get these guys revved up for a ready hot show. Ben, JJ, you guys ready?
Ready?
Yes, sir.
All right. Love to hear it. Love the enthusiasm in the voice. All right, let's get started. Ben, the Fed holds rates steady. Is this savvy or stupid?
They're in control. They're just showing you it. Savvy.
Oh, man. I had a comment that came straight to my mind. I thought, okay, that's not for work ready. So I'm going to skip that one. Okay, they're in control. We just got to accept it. JJ, Bitcoin ETF buyers, diamond or paper hands?
Paper hands. I think they showed that yesterday, right? We lost their average price. They started dumping. So it shows they're not the institutional investors we were hoping for, unfortunately.
Oh, man. Way to start off with some sour hour. All right, Ben, we discussed the Fed on Trading Pit. Too much, too little, or just the right amount?
Oh, never enough. We need more of it. And we need to talk more about rates and crypto. To just have 4 hours every day of it.
All right, guys, if you want that, put that in the chat. I'd love to hear your thoughts on 4 hours of rate talk. I, for one, am voting yes. All right, JJ, finding the right level of exposure in the market. Is it a dollar amount or a gut feeling?
I'd say it's probably a percentage amount rather than a strict dollar amount, depending on your portfolio. If you go with your gut, you'll probably blow yourself up, unfortunately. It can pay up sometimes, but you'll probably end up in a bad place if you trust your gut too much.
Okay. All right. There you go. So if you're nervous right now, your gut's telling you something, you should be looking at that percentage. Ben, last one here. BlackRock sees sovereign wealth funds pensions coming to Bitcoin ETFs. Is this hopium or uber bull?
Oh, I think they're just telling you the conversations that are already happening.
Trying to get us revved up, trying to sell their wares. That's the way it is. Guys, welcome. Love to have it. I see Preet, Adrian, David, Elisa, Alster, Mully, JB, KS. Glad to see you guys in the chat. Definitely hit the like and subscribe button. Share this wherever you want other people to be hearing a sophisticated discussion on the markets. And we're going to dive right into that. JJ, we got a lot of price action to be talking about. Interestingly, this morning I looked at the numbers. BTC was sitting about 58K, Ethereum at 3,000, Sol at 137. This looked very similar to how we ended Tuesday's show, but obviously since that time we saw a dip a little bit below that. But on the more macro front, we're seeing some challenges here. The ETFs had just an absolute brutal day, 563 million of outflows. IBIT had its first day of outflows at 36 million. So tell me, are you seeing something that's going to suggest this is getting worse? Or is this just a continued crab walk that we're going to continue to play out for the next couple of months?
So we had that sell-off. We were mentioning that dealers were short 60K puts and 59K puts expiring on Friday. And then once those levels broke, I believe it was Tuesday night, you saw that really rush to the exits. People were hedging en masse. There was a lot of puts opening at that level, and it was just kind of this crescendo fear moment, and that kind of bottomed out yesterday. And now it seems like we're going to be walking our way back into this range. I would expect us just to chop at least into the coming days here. Hopefully find a medium level here around 60K or so, but there's going to be a lot of resistance overhead. It's going to take a lot of time for this chart to repair itself. I don't think we'll be seeing any V-shaped recovery in the next couple of weeks here. I think it's probably more, we're just going to be doing the stair pattern where you go up, wipe out some shorts, wipe out some longs, and seems like we have a range probably around this is the 64K mark that we hit on. I believe this was Monday night when Asia opened. That's going to be pretty firm resistance now. So you're probably looking at like 62 best case to the upside, and then that 57K mark or so to the downside. We'll probably just be in some kind of consolidation pattern here for at least the coming days and see how it plays out from there.
You say the coming days. How long do you think this crab walk could play out if it really got extended? Is this something that could go deep into quarter three?
I think it could go through at least May. So we had this kind of, we were pointing to this, that the range wasn't going to last forever, right? We weren't just going to stay in 60K to 67, 70K for very long. Eventually there was going to be some kind of high volatility move outside of that range. It seems like that's what we got yesterday. I think there was around 15 bankruptcies on Deribit, which was a buy factor of people shorting put options, assuming that that 60K mark was never going to break. You could sell those puts, collect the free yield, essentially is the way they viewed it. This is kind of a common play. It got overcrowded. And then we saw that that trade blew up, right? So the hope here is that that marked the bottom or close to the bottom. Maybe we need to retest it a couple times and really cement it. But it's that's kind of the range break, right? So now I think we're back into this crab walk environment where we'll be in a low volatility period while price digests and tries to find a floor and a ceiling and just kind of creates a range. I would expect that to last at least a week or so, bearing any kind of macro factors from the outside. But it does seem like DXY's cooled a bit in light of the FOMC, so it doesn't seem like that risk of it running to 110 in the near future is something we need to be worried about in May at least. And we'll just take it from there. But I think we're probably just forming another low volatility range here, as we did after we lost that 70K level. Like this range was pretty low volatility. So I think we're probably in for something like that in the coming weeks. And then we'll see either a move to the upside, regain that momentum, or unfortunately the opportunity to trade toward the downside and revisit 50 to 45K or so towards the end of quarter two. So just seeing how price reacts in this level,
if we hit those bottom.
Go ahead.
Right. Yeah, no. So I guess I want to hear from you. Like, if you see a trend towards those lower levels, do you still see this in a broader cycle? If you look at historical context, does this give you any pause at all, or does this just seem, this is normal consolidation that you would expect sort of mid-cycle after the halving?
So far as now, I think this is a healthy reset. I think we had a lot of froth and excess leverage wiped out. So as long as price can kind of continue to form higher lows from here, build a nice base over the next coming months, I think this is a healthy setup for the second half of this year. If we do start trading lower and things go sour from here, I would be a bit concerned that this cycle isn't as parallel to previous post halvings. Like anytime you start to get a month, 2 months outside the halving, you want to see some positive momentum developing. If that starts to go the other way, that's going to be a major red flag.
I agree on that right there. Like, we have an expectation, I think, of end of May, maybe first half of June, that we see a bit of recovery here. And you start to see buyers step in and be aggressive on the books in some capacity, which is, we don't see it at all at the moment.
Mm-hmm.
And if you don't get that in June at the latest, there's some scary questions that come into your mind. Like, this cycle has played out. Like, I was just talking to the team yesterday, the quant team, and we went back and looked at how we thought the cycle was going to play out about a year ago. And we, I don't want to boast too much, but we nailed it. And we kind of had this whole expectation of how it was going to play out prior to the halving, where we would be at during the halving. We actually didn't think it was going to be all-time highs just quite yet. We had it kind of around 50K. So we kind of missed it essentially to the downside. But, overall, like the trend, the price action in general, that's the expectations are there. So looking forward and seeing what we think is going to happen over the second half of 2024, if we don't see it happening in June, that raises questions of like, is the cycle kind of left leaning? And I don't think it is right now, but we need to be aware that what are these invalidation criteria that we need to keep in mind, so that if they do creep up, what do you end up doing? That way you don't just become rigid in the market for the rest of the year.
Ben, I want to take that idea, like, obviously you had a good perspective going into this. We need to be nimble. When you look at you've talked about on this show about how this cycle is really about getting institutional infrastructure built out, getting that adoption moving. We talked just a few minutes ago about the ETFs just being lower than expected. I think we talked before about what came out of Hong Kong. It's still unclear if that was a real disappointment because some of the information seems to suggest maybe it was on point. But how do you think about that? How do you think about whether or not, from an institutional perspective, is some of this stuff starting to play out? Is it still too early? When you see IBIT having its first outflows, is that healthy, or is it more indication that no, the institutions aren't here? These are paper hands. This is just another vehicle to get in, and this is a bit of a red flag.
I don't think it's a red flag at all. I think it's just the appetite for this asset class was incredible. And those that wanted the exposure got that exposure. If they couldn't get it through self-custody manners, if they needed IBIT to go ahead and do it, they went ahead. They now have exposure. They're now sitting on great returns. And I forget who tweeted this yesterday. I saw it on your timeline, Marconi, off a quote, but this is becoming a very hated asset class. And the reason is because you're not in it, right? Anybody who's hating it just is missing out on gains. I think Peter Schiff is a prime example. He said, "Oh, I had this opportunity and I would have been up." And if the guy was in it, he would not be this beholden to gold and being such a hater. He would be praising it and probably trying to figure out how to get like 1-to-1 pegs of gold on the Bitcoin network.
Sure.
If anything. So I think this is fine. This is just a cooling down period. It's a reset for the second half. It's a reset for a potential ETF battle on the Ethereum front. That's going to be happening out, I would think, later in May and into June, and then probably hit the courts in June. But this is good. This is a progression. This is going to take time, and I still feel great.
Okay. Well, that's good perspective. I think when we see something coming out from BlackRock talking to sovereign wealth funds, or you see some of the information coming out about IBIT with a sell-off, the headline can really speak volumes in people's minds about where the market's going. And I think you've shared some context to think a little bit broader and longer. JJ, I want to bring it back to you. You mentioned, I think before, maybe I may be confusing with some of the information you put out on X today about the shorts getting squeezed out. Looks like they got a little bit blown out. When I was looking at options this morning, looks like there was a pretty healthy reset. What does that tell you? Is that going to take some fuel out of our ability to have an impulse higher or lower?
Yeah, this is going to take some time to repair itself. So if you look at the term structure chart, it got sent extremely out of whack due to that 60K mark failing and how many people were short the 60K and 59K puts, short dated ones. As those positions fell into the money, they had to buy short dated options to hedge, which means that they were buying up like these May 4th expiries, the 5th expiries. So you see this large spike here, and that's owed to people buying those up at basically any price. And then you see how this inverts as we get into May all the way through the end of quarter two. The premiums on these, or the IV on these, are actually lower than the front end. So ideally what you want to see is a curve that's rising. So you want to see an upward slope, not this kind of inversion. So this is just another signal that it's going to take some time and probably a bit of a consolidation in this period to really reverse itself and then ultimately get into a healthy structure here where it's upward trending through the rest of this year. But that's not something that happens overnight typically.
I think it's important too, just to kind of explain real quick, JJ, of just like, what does it mean to be short a put, and how does that put a dealer? What is the position they're in, and then how do they need to react and behave during a sell-off?
So what happens is that, say you have a 60K put that was expiring this Friday, and these people sold them when Bitcoin was at 65K, thinking, hey, this range isn't going to break. I'll collect an easy, say, $1,000. They sold the put for $1,000. Then all of a sudden you have a high volatility break on it, and everybody's buying puts at the same time. So it's not just dealers that are covering at that point. It's everybody else has Bitcoin exposure, and they say, oh, well, this could crash to 50K tomorrow. I need to buy a 59K put that expires at the end of Friday just to cover myself through FOMC. So as more and more people start buying it, dealers have to mark up the price of those puts. So then that put you sold for, say, $1,000 a couple of weeks ago, now it's 4x'd, and you're down essentially whatever that would be, 300% or so on that single position. If you have large loads of these positions, the way funds sometimes do, it gets reflexive really quickly. and then they have to buy more puts to hedge, and it just kind of creates this dynamic where everybody's rushing to the downside. And you could see this on this put skew chart here. So when this goes negative, it means people are paying premiums for puts compared to calls. So this actually reached the highest levels it reached since January after the ETF sell-off. So it's just showing how much the market was really reaching for protection here. So if you were somebody that were short these puts when they were trading at a discount to calls back in, say, late March, early April, then all of a sudden that dynamic that was working in your favor for so long as price was going nowhere, it turned on you really quickly, and it blew up. I think there was quite a few people that went bankrupt on their Deribit account yesterday just due to that dynamic alone.
It is really interesting, that dynamic, just to think of just, if I had sold you, JJ, a put contract and price starts to kind of rip to the downside, I'm in a pretty bad position. So I got to go ahead and I'm going to pay whatever it takes in the market to get further downside protection, because I don't know how low price is going.
Yeah,
and if it's a short, if that duration on that contract or the expiry is happening really soon, that's when prices can get out of hand really quick. They call that essentially the gamma squeeze kind of effect, where every $1 price move results in a greater than kind of $1 P&L change. So it's fascinating dynamic in options. That's why they like to call it convexity a lot. So appreciate you diving into that. And that kind of abruptness in the market is why we kind of have to have a little bit of a cool down.
It gives and it takes away. So like what we saw this week was the exact opposite of what we saw in February. So if you look at this point from like 52K upwards, this was a gamma squeeze to the upside. So it gives and it takes away too. And it's just, this is a measure of when funds get bored, they need some way to make returns, and I don't know why they do it, but they tend to oversell volatility, which has that rubber band effect, and it can blow up rather quickly. So you have to cover your tail risk. Always be aware of your tail risk.
Not good. When you see these funds blowing up. JJ, you mentioned you saw some bankruptcies on Deribit, but for the most part, I mean, those are smaller trading accounts, right? These aren't the large funds that are bringing in millions.
Yeah, it's probably a mix. I don't know who exactly it was, but substantial bankruptcies there. So anytime you see that, not good. It's just kind of that's lost purchasing power for the future too, which is unfortunate. So those are people that likely would have been buyers of Bitcoin at some point. Now they're wiped out. And that's the game. It's a dangerous game, selling volatility.
So JJ, yeah, that's the game. Yeah, you got to be in it with long play, and then you have to have some strategic mindset on risk management. That's a PSA coming in mid-show from Marconi. I do want to ask you, when you look about the positioning for the rest of the month, you were talking about the term structure still looking a little bit inverted. We haven't really set back to something that'd be a little bit healthier. When I was looking this morning, I saw a good amount of notional exposure that's going to be expiring tomorrow, and then the next big round is at the end of May, and then it really starts to trail off for the rest of the year. Any perspective there on is that just, we're looking at that end of May month? Is that people just really trying to see what the rest of this month is going to do before they start to figure out their game plan for the rest of the year? Are you expecting that to change over the next 2 weeks?
I think this is more a measure like the lack of people really placing bets now. I think it's probably going to be a ranging market, and then we'll wait for price to show its hand. Then you'll see the options market pile in, like whether that's a firm break below yesterday's lows. You'll probably see a lot of put interest coming in and really start betting heavy on the downside. Or if we do form like that higher low consolidation in May, then you'll probably see some later dated bets, call options coming in, and that'll give us the fuel for additional upside later in the year. But for now, I think this is just you could probably expect a ranging market, and I think that's what the options market's expecting from here. Is we had that high volatility move, and now it's time for a breather.
Yeah. Everything is about breathing, crab walking, and taking it slow and pacing. All right. So I want to give us plenty of time to unpack what we heard from the FOMC, talk about those outside forces that I feel are going to have just a huge play. In fact, we had a question here in the mark here from JB saying, what does the Japanese yen action mean for the crypto market? We have another question coming in from Adrian about coin earnings. So I want to see if we can touch on some of that. So let's start moving in, talk a little bit about the Dixie, and then I know we're going to get into the FOMC. As we do, I just want to give a shout out, welcome to everybody who showed up here today. I know you got questions on your mind about where this market's going to go and how long it's going to take to get there. That's what we're trying to unpack. So definitely, if you're looking to share this with as many people as possible who want a sophisticated take, who have the same question, definitely do so today. Hopefully we'll answer some of these questions, and if not, we'll see what we can do over the coming weeks, because most of this stuff's going to take a while to unfold. So JJ, looking at the Dixie, you mentioned earlier in this broadcast, it's not really heading right now today towards that 110. I think when I looked at it this morning, it's at 105.91. And when I looked at oil, I think it was about flat. Hopefully I got that right in that $80 range. What are those outside forces telling you now that we're past the FOMC? Are we seeing perhaps a cool off from there that could give us some fuel?
Yeah, it's consolidating below resistance, which is what you would expect after the massive move it had in April. It's just kind of chilling here. Didn't break out above this Bollinger Band, but it's still elevated. And I don't think there's any reason to say, hey, the top's in, rush into risk right now. You'll see that if we do get a firm break, I'd say probably below 105, 104.50 in the coming months or so. Like if Dixie just starts to trail off and show weakness, that's your risk on signal. But here, I don't think there's any rush to say, hey, this move's over. I think yesterday was probably better than expected in a lot of ways. If you listen to the conference, it wasn't overly hawkish. So we just have to see how this plays out. There's still the looming risk of liquidity factors and whatnot to be aware of that could play out. And so long as DXY is trending like this, that's always a threat, right? So until you see it really firmly move to the downside, again, I think it's just leaning itself towards a chop market for Bitcoin and risk in general. Some encouraging notes. The federal funds futures for December looked to have bottom. There's pretty substantial volume here that came in or below 94.90. And then we saw about a 10 basis point move up or so from bottom to high over the past couple of days. So that's encouraging. It's showing that the market is predicting some rate cuts before the end of the year. And these were almost priced out yesterday prior to the FOMC. So it's just the market doing the Fed's job for them. It seems like the Fed didn't have to do anything to make the market ultra scared, and they kind of got the reaction they wanted. And then they backed away from it and said they weren't going to hike rates. It wasn't really a thought for this year. So it seems like some easing there. We just have to wait to see it play out on Dixie, and that'll give us a signal to go long.
Okay, so it's looking like the dollar's cooling off just a little bit, or it's definitely not hitting that breakout. We've been waiting a long time to see if it's going to move up or down. Still don't have that, even after this latest FOMC. I know we're not rate specialists, and we're definitely not FX specialists. We certainly don't pretend to be. But when we hear this question from JB about the Japanese yen action means for the crypto markets, Ben, I want to get your take. Do you get any sense that, is there any commentary coming out of the Fed that they're looking at the impact that the dollar is having on maybe strategic partners like the Japanese, who may be impacted by the stronger dollar and need a little bit of support in some way, some accommodation?
I haven't heard any language specifically, and I haven't also been really trying to track it that much. But I think the takeaway on something like that, it just kind of showcases like, look, we've had various wars start breaking out. We've had even wars within oil-rich regions break out, and oil's not really moving a whole heck of a lot. And at the end of the day, we're all just fixated on what the Fed is doing, and whatever the Fed is doing tends to dictate markets globally. So the fact that we are looking at the yen, it's almost like we're looking at it because we're now curious what's going to happen in the treasury market, how Yellen would respond, how Powell will respond. And so what this is really just kind of confirming is just the importance that the Fed is placing in markets globally. And I mean, even if we go back to crypto and we look at, I have a chart pulled up on my screen of Panda Terminal. So real quick, shout out to the dev team that we have building out Panda Terminal. This is a product that we've been just starting to roll out to some members that we've had and clients that we've had for a couple of years. Just getting some feedback there. Building it up to release later, hopefully later this year to mass public. But on the screen, I just have a few stats on the order flow of whale demographics. And so if this is Bitcoin price here, we have the counts in terms of the amount of trades that are happening that are within the 1 mil to $10 million range. And you see a lot of red here, which is just suggesting that if there are going to be order sizes in that capacity, it's going to be on the sell side of late. You're not seeing buys really step in, and you can kind of see this is sort of that net on a 4-hour basis of what is that volume happening. And you can see it's just negative and prices kind of trending in the same direction. And if you were to take this value in white here and just kind of run it on a cumulative basis, you get CVD here. And you see it's just trending down. So you're really just seeing that in the market, the way that larger orders are responding is to the downside. You want to see them step up, but we're not. And down at the bottom here, I put DXY Risk Metric that JJ and I worked on together. And it's kind of a model that just helps us understand, like, what is the DXY doing? And is it kind of hitting an inflection point? You know, is the velocity in which that price is moving going to cause some turbulence in crypto? And so when it's at a 5 rating, that's kind of max risk. And you've had that as we crab walked within this trading range between 60,000 and kind of 72,000, if you will. And now we're seeing the effects wipe out price in this trading range coming down to the downside. So if I had to really sum up everything that we're talking about with the yen, with the Fed, with how the order books are behaving, it feels like the beginning of like a really important match in sports. And you're kind of feeling out an opponent in terms of where's the weakness, where's the softness. Like, you're not going to go out and really attack quite yet. It's a little bit of a wait and see. And then once you see that softness develop within their defense, or, you know, down the wing or something, then you'll go ahead and you'll start positioning yourself to attack it. And so if I could sum it up, because you see the orders coming in on the books, but it's in a passive manner. There's no aggression right now in the books. And we have all this kind of uncertainty. Luckily we had the FOMC happen, and they're kind of dialing back quantitative tightening in terms of their balance sheet. They tried to be as dovish as they possibly could on rates, but my takeaway there was, and if you were listening to Powell yesterday, he talked about getting 3 months of data of Q1, so January, February, and March, and then how they assessed it. What it sounded to me was they want another 3 months. They want to see what Q2 is going to do before they really decide to do something. And I kind of joked, and I said he wants greater confidence in being confident. And I think that's what that really is all about, is having that kind of quarter of data to go ahead and determine. So now their decision making is on a longer kind of duration and time frame. And so why are you going to try to start attacking the market right now if that duration has changed, if that time frame has changed? Like, the Fed is still kind of the most important actor in the market. So go ahead, be passive in the market, try to take some positions over a longer period of time, and kind of sit back, let the market come back to you. And then when you finally see that weakness, you can go ahead and attack. And I don't think we're going to see that until maybe the start of, or the end of Q2, early Q3.
Wow, a lot to digest. Or good analysis of the breakdown coming out of FOMC. So for the audience, I want to recap here, because the question started off with the Japanese yen. I think your point is everyone is focused on what the Fed is going to do, how long it's going to keep rates elevated. As we said before, they're keeping rates steady at that 525 to 550 for the foreseeable future. And I think they gave themselves a little bit of wiggle room to say, to your point, hey, we're going to wait for more data. We're in no rush to do any rate cuts, which I think now we're waiting for the dot plot to come out, maybe to get a better sense of when, how the market is going to start digesting that information, when they expect. But you're saying right now, for what you're seeing, is people are saying, listen, if the Fed's not moving, they're not going to rate cuts. We don't need to make any aggressive moves. We can wait to start to get a better picture of when that might happen.
Yeah. It's very like a slow moving sort of kind of match taking place, and understanding yes, what they're saying they're going to do, are they going to actually follow through? This time frame is longer, and so I think the Fed does expect that jobs are going to soften up. He even hinted at it, like, yep, we kind of expect to see some softness show up, but that's not like a cause for alarm. So, I don't. The conspiracy theory this morning is that, hey, the figures coming in tomorrow are going to be pretty soft, and the Fed was just trying to prepare ahead of time. Nobody knows really if that's true or not, but I think over a longer period of time, they do expect to see a bit of softness show up. And they're trying to say that that's not cause for us to raise rates yet. So they were trying to be as dovish as possible and try to get ahead of that conversation and narrative that the market might bring up. But you got Yellen that wants to basically issue more debt here in the coming months. And so I think what needs to happen is, yes, if Yellen's going to come out and kind of suck out a little bit more liquidity out of the market, how's the Fed going to help accommodate that process? And I think that's when we'll start to hear a conversation of maybe rates coming down a little bit.
Ben, I want to ask you about the terminal rate, because I know offline, and perhaps we mentioned on our last call, but we were talking about offline, really looking for some indication of what the Fed was thinking about the terminal rate. I know I had a summary up here. We were talking before the show saying, I'm not sure there was a clear message on that. What was your take on them, on what they did discuss or didn't discuss about the terminal rate, and how that may impact the narrative over the next couple of quarters?
I think Jerome lost some confidence in himself. And, he said that we were basically at terminal rates, like, get ready, it's cut season coming up, like, get your dry powder ready. Like, that felt like, this Q1 narrative, that even probably late Q4 of last year. And he's now coming back from that. He's backing up from that talk, because you know what? Maybe there is this possibility that inflation doesn't quite come down. He said that, I think rents are a very lagging data point that comes in. So he's trying to give himself a little bit of wiggle room there. But I think that's why he's so kind of cautious now in terms of when he's going to decide to cut. And that's why he's just trying to, I think, delay everything as long as he can, kind of do nothing. Doing something means doing nothing at the moment for him. And so he's just trying to buy time is kind of how I interpret it.
Yeah. Well, it's interesting to hear that how they're going to shift the narrative. I think Ali Alba says they always want to wait for more data. I think there's always sort of a fallback to
That's
say
the
we can
truth.
wait for more data, right? And to be fair, I mean, if I'm in charge of that position and I've got to be looking at, making these comments that are going to be public and on the record, I am going to want a lot more data to build that confidence. Part of me wonders if there was some work that was done in place to try and get better data, better processes. They put those in place, the confidence went up, and then the results came out. And now they're realizing they're not as strong as possible. I'm hearing a dog in the background that agrees with me. JJ, I want to get your take here on these outside forces. Is there anything else that you're looking at that's maybe giving you, some other insights, maybe some other early indications of, something you'd want to share with the audience that you're looking at?
Yeah, sorry, my wife just came home, so he's a little bit excited right now. So if we look at
always excited for whoever's going to give you the food to show up. Yes, I get it.
Exactly that. So if you look at what happened after March's FOMC on Bitcoin's price, so here it was on March 20th, Wednesday, March 20th, and we saw price just kind of chop back and forth. And I think this is probably what we could expect from BTC while we wait for DXY to make up its mind. Something similar to this, but to the upside, hopefully, where you would see it kind of come up. It doesn't really break out, it doesn't break down, then you see a move. And so when this move finally happened, it was about 3 weeks later. So it's probably a period about 3 weeks choppier for Bitcoin in the best case scenario, where it just kind of keeps forming higher lows the way it formed lower highs back in March into April. And then hopefully we see a breakout sometime in the second half of May or early June. And that kind of confirms that this week was the bottom. That's ideally what you'd want to see there, especially paired with a falling Dixie. But remains to be seen. So it's just kind of something like a scenario to keep in mind. You see Dixie start to fall towards 105 and below, and you'd want to see this kind of pattern from Bitcoin to the upside.
And that kind of lines up with, if Yellen needs more dollars, and we end up seeing that, DXY is going to soften up a little bit, and Jerome's talking about trying to be a little bit more dovish on rates here moving forward, or at least Fed speak through various media outlets, and like Nick on Twitter, Nick Temer, I forgot, I don't know how to pronounce the last name, but point being, this, you could see the DXY making that move, like you're saying, JJ, later this month, coincide with the roll off on the May expiry, just really set up for a strong June and July here. And maybe it's not strong, but at least just gaining momentum for what our expectation is a strong Q3, Q4.
Yeah, if you see some strong like accumulation channel behavior here, you could probably take that as funds that didn't deploy in quarter one or quarter two. And what you'd like to see is them start to deploy now, right? Like as Bitcoin forms a range, like say 65 to 59 or so, that would really be a strong base that we could accelerate off of in the second half of this year.
Okay, so some good thoughts, something to think about if you're trying to front run the market, to look at some of the signals that may be coming out of it. Ben, before we move out of outside forces, I do want to ask, I think I saw a schedule that came out this week about the Treasury wanted to do buybacks of bonds. I was again, it was making the circle around Twitter, on X, just around this I would say the sort of doomer pattern, if you will, for the people to say, look, again, everything is just kind of gonna fall to zero. I think this was telegraphed, this was discussed for a while. What is your take, if any? Is this being blown out of proportion in terms of why the buybacks are here? Is this something that could be seen as just really not a big deal? How did you interpret that information?
Yeah, the buybacks, that was in their press release on the Treasury site on yesterday. The quarterly refunding statement of Assistant Secretary for Financial Markets, Josh Frost. So in there, they talk about the buyback program that's coming in, and I don't really think too much of it, to be honest. I know it's kind of being made to be a big deal, but all it's doing is really making sure like there's prime treasuries in the market for trading. And so if you think, if there's an auction, say next week, I believe they're issuing some 30 years. And once that auction closes off, you have what's called on the run treasuries. And those 30 years, the newest issuance are on the run. And those have essentially a premium attached to them because they're fresh, right? They just got issued. And anything that is a previous auction or just later in a sense is just off the run. And so those have a little bit of a discount, and they're a little bit harder to trade in the secondary market. And that secondary market is the main point there, because once they're off the run, you're not really making these trades using the Treasury website anymore. So if you think about it, like if you were getting in on a venture fund, or I'm sorry, a financing round for a company, like, yeah, really early on or right in that financing round when things are taking place, like it's easier to make your moves. But once you kind of have your allocation and maybe you're even in a later round, like now you have to go and trade on the secondary market. That's very illiquid and it's very difficult to do. And kind of exaggerated it a little bit, but that's the main point there, because also like the terms of the coupon and what the cash flow is of that coupon and the pricing changes, it's just not that great for liquidity. So Treasury is just trying to make it easier for that liquidity to take place.
So not a real big red flag at all that liquidity is starting to seize up. We've talked a little bit about the sort of the signals that we're looking for liquidity Armageddon to start kind of ramping up, things like seizing in the commercial paper market, the real estate market, corporate bond market. Those are all could be indications. This is not one of them, in your opinion.
No, there's like a little spread that exists between on the run and off the run. And they're probably addressing that. I don't have the data on if that spread is of significance or not. I just look at what they're trying to do for May, June, July. Here's their on my screen right now. I have what they're trying to do moving forward for each each duration, the notes and bonds, in terms of how much they want to kind of drop into the market and hopefully raise. And nothing really like stands out here. Like if anything, the 30 year is not doing anything different. The 20 year, like they're not trying to address the later terms of the curve. If anything, you can see that they're trying to really get at the 5-year issue a little bit more. And so they're you can see on February they were doing 64 billion, 67 in March, and now they're just staying at 70. And so what that ends up doing is you got more supply in the market, so that should command a higher yield because you just have just more issuance in general. So ideally, you're supposed to satiate that demand, and so yields are going to come up, right? But if you go ahead and you pull up a yield curve, you can see that 5-year is much lower than the front end. So that's part of raising up the curve. And I would have to expect that the 5 and the 7 and the 10 is what they address here moving forward, kind of flatten out the curve a little bit before Jerome pulls the bed sheets to get a little bit of a cut and normalize the curve in the process. That's still playing out. I talked about it last year. I thought it was going to happen faster and quicker, but this is taking a long time.
Yeah. Well, everything can take a long time. Big ship takes a while to churn. Okay. So if you're seeing this on X or wherever you are engaging with people and they're talking about this as a red flag, definitely something to consider coming all the way from Ben Lilly. Okay, let's move into this next part, which is usually our last part, which is talking a little bit about trades. As we sit here in the crab walk, we've talked about this notion of, is this a good time to be sitting on your hands, waiting for a little bit more information? Even on this show, we talked about how the market is not really making any aggressive moves. They're kind of waiting on the sideline to see when we're actually going to see some of these rate cuts, when we're going to see improved liquidity. So this could be a good time to preserve capital, start doing some research. It may also be a good time to be talking about getting into options because the prices, as they start to cool off, there could be some really good opportunities for you. With that, I want to give a shout out to CoinCall. Sorry, got a little bit distracted there. CoinCall, they're the sponsor for this show. If you're interested in trading options, perps, or spot of the majors, it's a great place to do that. A great place to start your options journey. Check out the link in the description. And if you're curious and you haven't already looked at it, you got JJ's videos, which do all the education behind how to think about options beyond just the actual execution of it. And he's using CoinCall as his example, which means you're going to be able to follow along with him. You can start doing paper trades. You can start doing some small trades, especially if the market starts to cool off. The dollar price amount to get in is going to be that much lower. But definitely now is a good time to be starting that journey. So when those opportunities and those fat pitches come along, you're ready to actually execute. So, JJ, I want to talk a little bit about options, what you're seeing now, if this is a good time to be sitting on your hands or starting to look at some of those longer term plays. I also want to give a shout out. Adrian mentioned the note about coin earnings that are coming out today. I want to get your guys' general sense on some of the sort of the equity side, whether or not you'd be looking to play some of those as a beta to maybe to Bitcoin in the next quarter or so if we start to see some of the cool off start to turn around, we start to see maybe some momentum. So JJ, maybe we can start off with the options view and ask you, and again, that question, is now a good time to be sitting on your hands, or are you looking at some actual options plays?
Yeah, like short term, I really don't expect price to go anywhere. I think we'll probably be in that chop scenario I outlined before. You might see some kind of quick moves, like maybe it goes up to 62K in a single day. A lot of people rush in, and then it's back down, So in the short term, I don't expect too much meaningful volatility, like anything to the upside or the downside over the next week. I think we'll probably just be in this kind of consolidation pattern. So be prepared for some IV drip, but I do think longer dated options are a good play here. If you want to do some call spreads, I think those 70K calls expiring at the end of December, I think those are still a good play. And you could sell the June expiry against that. That'll take around 2,000 off your average price there if those expire worthless. And you just kind of let this range resolve itself. So you collect some premium on the near dated terms, and then you have that longer dated position for the end of the year. So if we do get that explosive move, DXY ends up falling, BTC ends up consolidating, making this breakout the second half of this year, you have that upside exposure, and it's basically paid for in part by this volatility you're selling. on the nearer dated strikes. And I think this is a good time to start looking at those. And as you start to get more confidence that BTC is going to break out to 70K, if we do see that kind of bullish consolidation period, accumulation take place in this, it makes some higher lows, then you could ultimately just go full and long in those end of the year 70K calls. And I think those will print pretty massively if we do see an expansion. But I think the risk reward here, given how much froth has been sucked out of the options market in the past couple of months, I think it's really reached an attractive level for those longer dated options. You could even go to September if you're riskier, more bullish, because those are about half the price as the December ones. So you could see how that plays out. You could sell the June against those as well, and then you're only at about 3,500 per 70K call. I think that's pretty good risk reward. You could sell. I mean, if you're really risky, we saw this played out this week, but the puts are trading at such an extreme premium now. If this is anything like January, that put premium will fall back down, so you could sell out of the money put spreads. I wouldn't do it personally, but that's a play here if you want to sell, say, like these May 52Ks or something like that, and kind of collect those premiums, but much riskier. And we just saw how that can play out rather quickly, so be aware. But that is a popular play now. Like if we look at
so depending on your risk profile,
we see a lot of May puts being sold. So here on the most popular trades of today, May 31st, 62K puts have been sold in pretty large amounts, about 1.2 million of premium sold on those. So that's somebody banking on us kind of reaching this consolidation range, us getting back into the 60K levels and ultimately consolidating here through May and those expiring worthless. So that seems to be what the options market's favoring, selling puts due to that extreme premium that they're currently trading at. It's riskier, but you can collect some nice premiums if you have the stomach for selling volatility. Just be aware of your tail risk.
Definitely need a strong constitution to enter some of these trades. I like the way you laid that out, though. There's a couple different risk profiles. You can be asking yourself how much risk you want to take on. Again, I would argue that there's nothing wrong with sitting on your hands a little bit and also waiting to see how this resolves going into May. Would you agree, JJ, or do you think this is definitely prime time to start to slowly entering into some of these positions?
Yeah, I think you'd want to wait ideally. Like there's no need to rush into a position here. I don't think we're going to see an acceleration to the upside. So I think you have times on your side here. Like you can wait to really build that position, see how things play themselves out over the next couple of weeks, and ultimately see what the macro forces are looking like as we get into the middle of May. See what Bitcoin's looking like. Is that consolidation pattern playing out? And volatility, you shouldn't make too big of a jump. Like if we're just kind of consolidating between 64 and 58, you'll probably see the IV drop off some more, and that'll really give you some good risk reward on those longer dated calls. But if you're in a rush to get in position, if you've been sidelined, I don't think call spreads are a bad idea if you want that upside exposure. And if you have more of a stomach for risk, then selling puts is a popular trade today due to that spike. It's not my game, but people like to do it.
Okay. Sure. Yeah, definitely a higher risk play. Okay. We have a couple of questions here. I mentioned already the one about coin call. I want to come back to that and JJ, get your perspective. There's one in here. Ben, I'd like to get your thoughts here. It comes from Baja saying that ETH-BTC to be the bottom with volume, or JJ was looking for an ETH-BTC pair to really bottom out on some volume buying. Is it possible the bottom is already in? We haven't seen the volume yet. So Ben, we've talked about this several times on this show. I know obviously you're a longer term player when it comes to Ethereum, but you have been looking for that bottom to finally play out. Do you think, especially when I looked at price just on a USD basis over the last 7 days, Bitcoin was down about 8%, Ethereum only 4%, and it's continued to be rather resilient, I think, and that's what Baja is kind of pointing to. Do you still expect that capitulation point coming in with volume? Is it possible that the bottom's already in? What's your take?
Its reaction's pretty impressive past couple of days. I'm not 100% sure, period. And because of that, I wouldn't make a decision that expresses essentially that certainty. And what I mean by that is I've been meaning to for a long time. I actually joked even in our Discord that I finally remembered to go ahead and enter ETH in kind of my retirement account. And I've been wanting to do that for a while. But the reason that I remembered it is I was looking at the ETH-BTC chart and I was noting how it's been kind of behaving over the last few days, and kind of reminded myself, oh, hey, why don't you go ahead and finally do that thing you've been holding off for a while? And I put about, in terms of the amount of dry powder I had in that account, in terms of the amount I want to allocate to crypto, about 50%, 50, 60%. So it was, and the reasoning behind that is I'm kind of looking at the way that whales are behaving on the books. And you see kind of this bid ask ratio, which I just dropped into the Telegram chat. You see it's healthy and it's strong. And this is kind of the early process of a bottoming out phase where you see kind of a timid approach to the market, kind of just dipping the toe in, sitting there waiting the market to kind of come into those bids and fill up. And the way that JJ expressed options, right, that has a lot to do with time decay, right? You can't enter a position if the timeliness isn't in your favor. Where if you're just going in on spot, you do have time, especially on spot, and you're not using leverage. So when I see ETH-BTC, it does behave the way that I'm hoping it to behave going into Q3. And I do expect a bit of a capitulation on the ETH-BTC. I'm sorry, ETF news, and as well as all the regulatory pressure that's facing right now. I would have to imagine there is going to be a little bit of a moment in the market where there's going to be a lot of coins exchanging hands. So I still look to see that, but I'm not going to necessarily wait for it fully. Okay. If we do see it, and then you see the strength on the heels of that move, that should be confirmation for you to go ahead and do what you want to do. And I know there's a lot of hate on this ETH-BTC chart and trade, but I think a lot of individuals believe that like you're moving in terms of leverage, you're trying to leverage that chart, but really it's just timing of like what ecosystem or what coin is kind of your major position in your portfolio. Is it Bitcoin, or do you need to allocate a percentage and shift it over to Ethereum? But I think more importantly, you need to realize what that also tells you, which is when Ethereum is starting to outpace Bitcoin, it's suggesting that large cap L1s outside of Bitcoin, like Ethereum, like an AVAX, like, I hate to say Polkadot because it just feels like a barren chain, but even perhaps Solana and the Cosmos ecosystem, these are just telling you where to go start looking and be ready for when the microcaps start moving in, say, a month or 2 months later and after the fact, because there's going to be a wealth generation taking place event as these native tokens of these L1s grow in value. And the immediate response when that happens is, now what do I do with this newly accumulated wealth? Well, let me go take a gander down the risk curve, go check out some DeFi and other protocols that exist and drop my tokens over there. So that's the signal that happens. It's not just sitting ETH. It's, you can now start looking at large cap L1s in those ecosystems.
So hopefully, I think, Baha, that's a very nuanced and sophisticated take on looking at that ETH-BTC chart. JJ, I thought I heard you wanting to get in and add some color.
Yeah, there's nothing to say that volume can't come in higher too, right? So this could start to break out, and then you would see people shift over their Bitcoin to ETH higher. So that's always a positive. It doesn't necessarily have to happen to the downside. Could happen to the upside too. And it just seems like it might be time in the coming months or so. Once Bitcoin finally finds its footing, I could see ETH running from here, and we could possibly see that volume come in at, say, 0.053. Maybe this is where the volume comes in. But I think once that volume's in, that you'd want to see kind of a shelf build up over time. So it's probably a period of consolidation between 0.06 and 0.045, whatever the lows were of last week. So we'll probably be chopping here, and then once it's ready to go, it's going to go. But you'll see that volume shelf build up. And I think this is probably the point in time where we're going to start to see some volume coming here. So it's been so dead for so long that I think people are going to begin rotating once that overhead catalyst of the ETF things out of the way. You'll start to see it, like the way we saw this volume shelf build up in 2020.
Okay.
Before it really made the move, right? You see all this volume that took place here, and that's really what catapulted it. So I think we're probably at the beginning of this, somewhere around here.
Mm-hmm. So exciting times for Ethereum, BTC down the way. Obviously, need to continue to monitor for the macro markets and to continue to see how this plays out over the next 6 weeks as we head into June. Okay, so I want to wrap this up with a discussion on sort of these beta plays. A little bit of a question around coin. Again, Adrian was saying coin earnings are due today after close. Thoughts on that and the impact? Masari has them beating consensus yet again. So I think there's implied in there that the market is mispricing maybe some of these equities. If we look at coin as one example, we obviously have the Bitcoin miners, MicroStrategy. So JJ, I want to come back to you. You know, we've talked at times on this show about playing some of those as a beta to sort of Bitcoin's moves. Now that we're in this crab walk, and you could see someone like Coin outperform because of their revenue strategy, either on base or on just on the trading volume that they have, which could come in obviously for a lot of tokens that are further down the risk curve. What's your perspective on playing that versus as an actual opportunity to add beta to your Bitcoin or your Ethereum?
Yeah, I don't really love these here. I think these are more plays when Bitcoin's breaking out of range, when Bitcoin's really accelerating. But when Bitcoin's in a downward period or chop, these tend to outperform to the downside. So that's beta gives and beta takes away, right? So if Bitcoin isn't trending, I think you could see some kind of short squeezes here, but I doubt you would see like coin make a breakout above the highs while Bitcoin's still trading below 70K. I think it's all dependent on Bitcoin's moves. So even if earnings are great, I don't see these I wouldn't see coin really making too large of a move. Maybe it could have 10% overnight day and then it just continues to chop until Bitcoin ultimately resolves to the upside. So I think the time to get into these would be, and that goes for all of it. So coin, MicroStrategy, the miners, I think they're all dependent on Bitcoin really getting back above, say, 66, 67K. And that's when you would really see those beta effects kick in. And then you see those large 20, 30% moves in a day from those beta stocks. But when Bitcoin's in range, they tend to behave similarly and then kind of like a downward chop period. So I don't think it's a great time for them until you see some more decision from Bitcoin.
Okay. So if you're looking at playing those, most likely you're going to be better off waiting until we have some decisive moves coming in from Bitcoin. And that could take definitely the next couple of weeks, even going into June, where we're obviously hoping to see some good momentum start to pick up. And with that, we're going to wrap up today's show. Definitely an interesting time to be in the markets as we continue this crab walk and looking for this to start to turn around. I want to thank JJ and Ben Lilly for joining today, breaking down the FOMC, breaking down the price action. And for all you in there in the chat, love having you here. Definitely be back every Tuesday and Thursday. We're going to continue the conversation, continue to monitor, drop the alpha so you can figure out how to play your portfolio. I'm going to leave you with the same PSA. You're going to want it, especially as we head into these uncertain times. Have some dry powder so you're always ready to deploy. This is Marconi White signing off.